So I wanted to start with the revenue growth comparison going back to 2015. And NICE and ANET started their revenue around the same level in 2015 with around 900 to 800 million in revenue. Arista Networks since then has grown its revenue much quicker than NICE, increasing to 8 billion in trailing 12-month revenue, most of that coming since 2020. That's good for a compounded annual growth rate of 26.7%, which is more than double the compounded annual growth rate of NICE in that time of 12.5%. Again, they started around the same levels in 2015, around 17.8%. And Arista Networks expanded its operating margin to over 43% in that time, an excellent improvement in margin, but also an excellent number in margin. The next metric I wanted to compare these two on is return on invested capital. And in this regard, we're seeing a couple of different things now. Whereas in the previous two metrics, we saw Arista Networks both having the better number and the better trend. In this metric, which in my opinion is the most important metric, Arista Networks has the better number by far, but doesn't have the better trend. In fact, its trend is worsening meaningfully from 93% in 2018 down to 51%. An ROIC of 51% is incredible. It's among the best of the best in business worldwide. But the trend is a little bit alarming. NICE has improved its trend from 6.9% in 2018 up to 14.5%. An ROIC of 14.5% is solid. It depends on your weighted average cost of capital. The general rule of thumb I like to consider is an ROIC that's greater than the WACC, weighted average cost of capital. And I'll share with you these companies' weighted average cost of capital in the next slides when we look at valuation. Lastly, I like to look at valuation on a forward price to earnings basis, and Arista Networks is trading at a forward price to earnings of 48 compared to NICE, which is trading at a forward price to earnings of 11. That being said, I do believe Arista Networks deserves a premium valuation. Its revenue growth rate is more than double that of NICE. Its operating profit margin is improving and more than double that of NICE. Its ROIC is above 50% and boasts a 4-to-1 ROIC to WACC ratio. So a forward PE of 48 looks, I would say, undervalued for a business of this quality and these levels of metrics improvement.
Click the link below to watch the full video.